Hello everyone, welcome to the chapter 3 of Real Earnings Management tutorial series. So here we're going to look into the calculation or the components, the theory aspect of that calculation. This part is crucial, so do not skip. So I tend to keep the video short because it would be easier rather than having a 1 hour, 2 hour series that you have to watch again and again and again. So let's go again. So REM, which is explained in chapter 2, the real earnings management model. So this is based on UK GAAP, United Kingdom generally accepted accounting practices. So like explained in the last series, REM is the sum of abnormal cash flow from operation, discretionary expenses, and abnormal production cost. So this is the formula. But this formula seems easy. However, the calculation, the components to derive this is a bit difficult compared to discretionary accruals earnings. Okay, first of all, what you have to do in step 1 is to determine actual levels. So determine the actual level of cash flow from operations, like the discretionary expenses, the production cost, and the cash flow. So if you are a student who's in a country where you practice UK generally accepted accounting practices, the discretionary expenses is determined as the sum of admin expenses, distribution expenses, and other expenses. You can get it from the cash flow statement. Now, if you are a student who's following or in a country where USA generally accepted accounting practices defined, so the discretionary expenses, the sum of research and development expenditures, advertising expenditures, and selling general and administrative expenditures. So make sure you follow the correct definition and the correct admin expenses when it comes to creating the discretionary expenses and production cost. Okay. And you can get advice from your particular supervisor, or you can research into prior research done in your country or in your sample data. Step 2, you have to calculate the normal cash flow from operation. So this is the formula. So CFO, all these abbreviations are given at the end of these slides. So CFO is the cash flow from operations, A is the asset, and these are alpha 0, alpha 1, the log of assets, alpha beta B, beta 1 plus beta 2, and ST is for the current sales, and epsilon at the end is the errata. Do not worry, but I'm just saying the theoretical or the foundational theory behind how to do this. But we will see the practical example in the next session. Once you have calculated normal cash flow from operations, step 3 you have to do, calculate the cash flow from discretionary expenses. Likewise, similarly, discretionary expenses divided by asset prior year, alpha 0, alpha 1, beta, and epsilon. And step 4 is calculate normal cash flow from production cost, and this is the formula for the production cost. Do not worry, the symbols will be like confusing at the first, but there is an Excel sheet where you can see all this information. Now, meanings of the abbreviations. So COT, operating cash flow from firm I in the year T, product cost of sold and changes in inventory, and discretionary is like research and development, advertising cost, and sales and administration for US. But if you are in UK, like I said in the earlier slide, please follow this. I'm just giving you an example. And A is for total sales asset at the end of the year, changes in the company sales, and change from T minus 1 compared to the end of year T2. Okay. And once you have done that, step 5 would to calculate the abnormal cash flow. So A, B, and C are for actual cash flow from operation minus normal cash flow from operation. So this is from the equation 1, and abnormal expenditure is discretionary expenses minus normal discretionary expenses from equation 2, and abnormal production expenses, actual production cost minus normal production cost, equation 3. Once you have done this, once you add all these three, abnormal cash flow, abnormal discretionary, abnormal production cost, you will have the final figure, real earnings management. So this is the simplest way to calculate real earnings management. But the only question is that you have to be aware whether you are following, whether the sample set you are using belongs to the UK generally accepted accounting practices or US generally accepted accounting practices. Okay, make sure, because I have done a screenshot here. This abbreviation for the DST, this is based for US. But if you are a UK or generally accepted or IFRS, International Financial Reporting Standard adapted country, make sure you define or you provide, okay, I'm using this is my discretionary expenses. And this is the reference, Rahul Chaudhary. So thank you everyone for listening to this short video series. And I will come back with you guys for the next session where we'll dig into the practical using Microsoft Excel.